So this is the second part, and in the second part of liquidity concept, look at how pricing moves from internal range liquidity to external range liquidity. But before we start, I would like to define what these two things mean and how you can always view them in the marketplace. Uh, Whenever you hear the word internal, it brings something in your mind, and that has to do with something that is inside of something, right? Internal. That means there's a thing that has something inside of it. And anytime you hear the word external, something should also ring in your mind, and that has to do with something outside. So, in the marketplace, we have two scenarios or two conditions, and that is that we have when the market is trending, and we have when the market makes a turn. Anytime the market makes a turn, I said it creates what? Either buy side liquidity or sell side liquidity, depending on which side of the market you're looking. So for this particular one, this buy stop, this sell stop are external range liquidities. Okay, why are they external? They are external because they are outside of the entire trend. They are outside of the entire trend. So the next thing we are going to look at is the internal range liquidity. So this is external range liquidity right there, which is the buy stop. Also, anytime you have liquidity pool, or just to make things more professional, this is known as buy side liquidity pool. Buy side liquidity pool right there. And if it is on the sell side, that means you have double bottom or triple bottom. That is your sell side liquidity pool. This is also an external range liquidity because it is outside of the trend, it is outside of the entire move. So if you have a move from this low to this high, then this low and this high, the swing points are the external range liquidity. But when you now have something which I will explain in between this low to this high, that becomes your internal range liquidity. For instance, from this low to this high, which candle is the longest? This one. And why is it the longest? It is the longest because it is the longest. And the fact that it is the longest makes it to create the widest gap. And the gap is what? Our fair value gap right there. So you all know, you already know what a fair value gap is. A fair value gap is when price moves fast out of a particular range, thereby creating a candle that has almost no wick. And if you look at this candle, it meets that definition. So how do you draw your fair value gap? Draw your fair value gap by picking the candle before and the candle after. So the candle before the massive candle is this small one, so you take the high. The candle after the massive candle is this one, so you take the low, then you project it forward. Wherever you have that space becomes your fair value gap, and that becomes your what? Internal range liquidity. So I'm taking my time to explain all these concepts one after the other so that no one gets lost. So this becomes a fair value gap, and it is expected that price should trade back into this fair value gap to fill up the gap. Why is it a fair value gap? Why is it a fair value gap? Internal range liquidity. That's because during or while price was creating that gap, there was almost or no trading activity inside of that gap. So it becomes a liquidity pool, becomes a liquidity, a point of liquidity, because there was so much influx of money or anything you want to call it, such that retail traders like you and me were not able to catch any move inside of this large expansion. So US price would always come back for fair valuation. Fair valuation. The word fair, when they say something is fair, means fair price, right? It's not fair when price just flies away. But fair, it becomes fair when price comes back into the area to fill up the gap and then continue moving to the upside. So this type of liquidity is known as internal liquidity. And if you notice, it exists between the swings. So we have a swing high there, and at the same time, we have a swing low. So this is swing high, and this is swing low. So between this swing high and swing low, we have our what? Our internal range liquidity. But the swing low and swing high themselves are what? Are our external range liquidities. That is very clear. So this concept is also very important for you to understand. It's the liquidity concept. A lot of you only know buy side and sell side. You do not know any other one. Another one is when you have a gap. I might not be able to see a gap here, but a gap just means you have a candle like this, and then the next candle opens and creates a void. So the space between these two candles becomes a liquidity void. And it is expected that the way price came back to fill up this gap, that it comes back to fill up the void. You can see each candle opens after the other, but there are instances where one candle opens far away from the last one. That creates a liquidity void, and that void must be filled. And that void also is an internal liquidity. Okay, so there are other ones. Just know that any liquidity, anything that price needs to come and mitigate inside of a trend is internal liquidity, and anyone that has to do with stop running, turtle soup, they are all external liquidity. Okay, so that is one. That's the second part. Now, the third part is that why will price move from external to internal? Price moves from external to internal and then internal to external liquidity in order to make money for the market makers. And what I mean by market makers is that those who are in charge or those who decide where the trend goes. They are those known as the market makers. They are the deciding factor. If price is going to buy or if price is going to sell for the next 6 months, the market makers are those who make that decision. But like I said, here we only have the algorithm, which is a computer programming that was used to design this software, this volatility index. So it is also what decides where price is going to go, right? And they always move from internal to external, external to internal, like that. So why do they do that? They do that to make money. They do that to take out stop losses. They do that to deliver fair price. Okay. So for instance, this is a buy stop, and that makes it a liquidity point. Price goes there, takes the buy stop. Okay. So another one is price creates equal highs, goes to take that equal highs, and so on and so forth. So the fourth part is price likes when it comes to liquidity, we can either have high resistance or low resistance. High resistance is those liquidities that lie between this high to this low. If you look at this low and you look at this high, we have this swing. This is a low resistance. Okay, which means Okay, let me find a perfect example that will make you understand this concept very well. I like this volatility index. They trend well and the price action is very clean. And if you trade it, you really enjoy your trading. If you know what you're doing. Okay, so eh, I've not been able to find. I need a scenario whereby price. Okay, I think I've seen one. Good. Now, if you look at this from this run down here and this run high to the upside, we probably have a okay. Let's take this high and let's take this low. This high can be traced because it stands alone. It can be traced to higher time frame, such as daily. But this one, the one between this high to this low, might not be able. You might not be able to trace them as a standalone swing point on higher time frames. So in such situation, this one that stands alone that can be traced, this might be a daily buy stop. That point is a high resistance, is of high resistance. But the one between this high to this low, every other high, these are highs, this is high, this is a high. And as price takes them, they are low resistance. They have little pressure on price as it trends up. That is all. That is all I'll say about that. Okay. So I believe I've been able to touch every aspect of the liquidity concept in a very simple way. It's not as complicated as we have it in foreign exchange. This one is very simple. Just understand internal liquidity, be able to identify it, be able to identify the buy stop, when prices form liquidity pool, uh, and so on and so forth. So lastly, before this particular session comes to an end, whenever you have buy side liquidity pool and you do not have market structure break, they are going to come for that buy side liquidity. They are going to come for the stop losses. They are going to come for the stop losses. Take that from me. So for instance, this low, and then price makes it back here and tries to come down. If they do not clean out all this low by breaking market structure, such as even closing below this, then do not look for any selling opportunity. Because if they don't break market structure and they are forming equal highs, they would definitely go and take the stop losses because that is exactly what they are trying to do. The same thing for sell side. Okay, so um, this is just the overview of the liquidity concept. Throughout the week, we'll be talking more about the liquidity concept. We'll be understanding, and from there, we'll go into understanding the price delivery algorithm. And in the price delivery algorithm, we'll now start talking about the PDRs, start talking about fair value gap, liquidity void, order blocks, proportion blocks, breakers, and so on and so forth. But for now, what I've been able to do is just to show you how to, when you're analyzing your charts and trying to annotate, your chart should look like this, what you're looking at on my screen when it comes to finding your buy stop, sell stop, internal and external, and so on. So, thanks for listening, and I hope you learned one or two things in this video.